Welcome to Indonesia Economy Focus, your monthly insight into the economic developments shaping Indonesia's business landscape. I'm your host, and today we'll be examining the key economic trends from April 2025. This month presents a mixed picture with some concerning signals. Manufacturing activity contracted sharply for the first time in 6 months, while inflation jumped following the expiration of electricity subsidies. Both developments raise questions about Indonesia's growth trajectory for the remainder of 2025. Today, we'll analyze these developments along with other key indicators, examine sectoral performance, assess the investment climate, and look at what all this means for Indonesia's economic prospects in the coming months. April 2025 presented Indonesia with a complex economic landscape characterized by divergent signals across different sectors and indicators. The month was marked by an acceleration in inflation amid the Eid al-Fitr festival season, which coincided with a sharp contraction in manufacturing activity. Preliminary data showed Q1 2025 GDP growing at 4.87% year-on-year, below the 5.02% recorded in Q4 2024. Suggesting the economy is entering a period of below 5% growth. This moderation comes as Bank Indonesia revised down its full-year growth forecast to 4.7% from the previous 4.8% while the government maintains its ambitious 5.2% target. The Jakarta Composite Index showed resilience with a 3.93% gain in April, recovering from early month turbulence triggered by new U.S. trade policies. However, foreign investors recorded net outflows of IDR 20 trillion, indicating persistent caution about Indonesia's economic outlook. These developments create a challenging environment for policymakers as they attempt to balance growth support with price stability, all while navigating increasing external pressures. Turning to key macroeconomic indicators, April's headline inflation jumped to 1.95% year-on-year from 1.03% in March, primarily driven by housing costs following the expiration of electricity subsidies. While this represents the highest inflation reading since August 2024, it remains within Bank Indonesia's target range of 1.5% to 3.5%. Core inflation reached a 22-month high of 2.5%, suggesting some building underlying price pressures. The labor market has shown relative stability, with the most recent unemployment rate at 4.91% in the September quarter of 2024, though comprehensive April figures are not yet available. The government maintains its target of reducing unemployment to between 4.5% and 5% by the end of 2025. On the monetary policy front, Bank Indonesia maintained its benchmark rate at 5.75% during its April 2023 meeting, with the deposit facility rate at 5% and the lending facility rate at 6.5%. This decision reflects the central bank's assessment that current settings remain appropriate to support growth while keeping inflation within target, despite emerging manufacturing weakness. Fiscal policy continues to target a deficit of 2.9% of GDP in 2025, up from 2.4% in the previous year, suggesting a moderately expansionary stance. However, the government's fiscal flexibility appears constrained by stagnant tax revenue and public resistance to tax reform initiatives. The combination of these indicators paints a picture of an economy facing increasing headwinds, with policymakers maintaining a cautious approach as they navigate the balance between supporting growth and maintaining economic stability. April revealed significant divergence in sectoral performance across the Indonesian economy. The manufacturing sector recorded its first contraction in 6 months, with the PMI falling dramatically to 46.7 from 52.4 in March, marking the steepest decline since August 2021. Both output and new orders shrank, while employment in the sector fell for the first time in 5 months. This manufacturing weakness represents a concerning development for overall economic momentum. In contrast, The agriculture sector demonstrated robust performance in Q1 2025, growing at 10.52% year-on-year, according to preliminary GDP data. This agricultural strength provided an important counterbalance to manufacturing weakness. The digital economy continued to be a bright spot, with steady growth in e-commerce and digital payment transactions. Fintech innovation remained robust, with continued investment in digital financial services across payment systems, lending platforms, and wealth management solutions. The energy sector underwent significant changes with the complete expiration of electricity subsidies that had been in place during the first 2 months of 2025. This policy transition contributed significantly to April's inflation jump, with electricity tariffs adding 0.97 percentage points to monthly inflation. Food production faced ongoing challenges, with food inflation accelerating slightly to 2.17% year-on-year compared to 2.07% in March. Key commodities driving this included red onions, red chilies, and tomatoes, suggesting persistent supply constraints. The accommodation and restaurant sector showed moderating inflation at 2.14%, down from 2.26% in March, suggesting some easing in service sector activity following the Eid al-Fitr holiday period. This sectoral divergence underscores the importance of targeted policy approaches to address specific industry challenges while supporting overall economic resilience. Investment activity in Indonesia showed resilience in early 2025 despite emerging economic challenges. Q1 2025 investment realization reached IDR 465.2 trillion, representing a 15.9% year-on-year increase. Notably, domestic investment grew faster at 19.1% compared to foreign direct investment at 12.7%, with domestic investment slightly outpacing foreign investment for the first time since Q3 2021. The downstream processing sector, particularly in minerals, was a significant investment driver, recording 79.82% growth. This reflects the government's successful policy emphasis on increasing local value addition and reducing reliance on raw commodity exports. However, foreign investment flows faced headwinds from global uncertainties and trade tensions, particularly following the implementation of new U.S. tariffs that affected market sentiment. The manufacturing sector's sharp contraction in April may further impact investment sentiment in the coming months, particularly for export-oriented manufacturing investments. Business confidence indicators showed some moderation, with the Consumer Confidence Index declining to 118.2 in April from 120.5 in March. While still in positive territory above 100, this decline suggests possible caution in consumer spending patterns ahead. The high and rising incremental capital output ratio highlighted in economic analysis suggests that investment is not translating efficiently into economic output, pointing to structural inefficiencies that may dampen returns on investment and limit the growth impact of capital formation. For businesses, the investment climate remains generally positive, though with increasing sectoral differentiation and growing importance of alignment with government priority areas such as downstream processing and infrastructure development. Regional economic data reveals persistent disparities across Indonesia's diverse archipelago. Java continues to dominate economic activity, contributing 57.43% to GDP in Q1 2025 and growing at 4.99% year-on-year. In contrast, outer regions face distinct challenges, with eastern Indonesia particularly vulnerable to price pressures. The highest provincial inflation in April was recorded in Papua Pegunungan province at 5.96% year-on-year, significantly above the national average of 1.95%. This substantial regional variation reflects continuing economic disparities between Java and the outer islands. In contrast, Ternate Municipality recorded inflation of 3.35%, illustrating varying economic conditions across urban centers outside Java. Within the ASEAN regional context, Indonesia's economic performance positions it in the middle range among regional peers. The preliminary Q1 2025 GDP growth of 4.87% outperforms some neighbors, but trails behind Vietnam's reported 5.5% growth during the same period. The manufacturing contraction observed in Indonesia in April diverged from the experiences of some ASEAN peers that maintained manufacturing expansion, potentially impacting Indonesia's regional competitiveness in this sector. Indonesia's policy stability, with maintained interest rates and a transparent monetary policy framework, provided a relative advantage in terms of economic predictability compared to more frequent policy adjustments in some regional peers. However, infrastructure gaps and logistics challenges continued to create competitive disadvantages relative to more developed ASEAN economies. The government's ongoing efforts to develop economic corridors outside Java, including infrastructure projects in Sumatra, Kalimantan, and Sulawesi, aim to reduce these regional disparities, though significant work remains to improve connectivity and economic opportunity in less developed regions. Indonesia's external economic position in April 2025 showed signs of resilience despite challenging global conditions. The trade balance recorded a surplus of USD 2.5 billion, slightly down from the USD 2.7 billion surplus in March. Export performance faced headwinds from U.S. tariff policies and weakening global demand, particularly affecting manufactured goods. The rupiah experienced significant fluctuations during April, beginning the month at 16,735 and ending at 16,554. Representing a modest 1.08% appreciation over the period. However, the currency hit its weakest point on April 8, when it touched 17,071 against the US dollar, before gradually strengthening through the remainder of the month. The rupiah remains at levels not seen since the 1998 financial crisis in overseas non-deliverable forward markets, indicating persistent pressure. Foreign exchange reserves stood at USD 157.1 billion at the end of April, a decrease of USD 1 billion from the previous month, but still providing a substantial buffer against external shocks. The global economic environment presented significant challenges, particularly following the implementation of new tariffs by U.S. President Donald Trump that triggered market turbulence at the beginning of April. The ceramics industry was particularly affected, with export volumes reportedly declining by 10% as supply chains faced disruption. Bank Indonesia explicitly cited U.S. tariff disruptions as a factor in its downward revision of the 2025 growth forecast, highlighting the significance of these external pressures on Indonesia's economic outlook. Indonesia's ability to navigate these external economic challenges will depend significantly on maintaining adequate foreign exchange reserves and prudent management of international capital flows, particularly as global interest rate dynamics evolve and trade tensions persist. Looking to the next 3 months, Indonesia faces increasing economic headwinds that will require careful navigation. The sharp manufacturing contraction in April raises significant concerns about second-quarter growth dynamics. If this manufacturing weakness persists through May and June, it could substantially drag down GDP performance for Q2 2025. Inflation is expected to moderate slightly in the coming months as the base effects from the electricity subsidy expiration gradually fade. Trading economics forecasts inflation to ease to 1.8% by the end of the second quarter. However, core inflation may continue its gradual uptrend, requiring vigilant monitoring by policymakers. Financial markets face potential volatility, with analysts warning specifically about selling pressure in May following the traditional sell in May and go away pattern. This pressure could intensify after the dividend distribution season concludes. Bank Indonesia is expected to maintain its cautious monetary policy stance in the near term, balancing growth support with inflation management. With inflation still within the target range, despite the April jump, drastic policy rate adjustments appear unlikely unless economic conditions deteriorate significantly. For businesses, the near-term outlook suggests a period of heightened vigilance, with particular attention needed to manufacturing sector developments, consumer spending patterns, and global trade policy evolution. Companies may need to prepare for a more challenging operating environment in the coming months. Key indicators to monitor include manufacturing PMI for signs of recovery or continued contraction, inflation trends particularly in core components, and foreign investor behavior in Indonesian financial markets. The government's policy response to emerging economic challenges will also be crucial in determining whether Indonesia can maintain its growth momentum or will face a more pronounced slowdown. To summarize April's economic developments, Indonesia finds itself at a potentially pivotal moment in its economic trajectory for 2025. The manufacturing contraction represents a significant warning sign, while accelerating inflation following subsidy removal tests the resilience of consumer spending. These developments come against a backdrop of preliminary Q1 GDP growth that already shows moderation to 4.87%. Yet Indonesia's economy continues to demonstrate important strengths, with agricultural sector robustness, digital economy growth, and resilient investment flows providing counterbalance to emerging weaknesses. The policy response in coming months will be crucial in determining whether the current growth moderation represents a temporary soft patch or a more persistent economic slowdown. As we close, two questions for our listeners to consider. First, how should Indonesian businesses position themselves strategically if manufacturing weakness persists through Q2? And second, will Bank Indonesia's current policy stance prove sufficient to navigate the competing challenges of growth moderation and inflation pressures? That concludes our Indonesia Economy Focus for April 2025. Thank you for listening, and we'll see you next month for our continuing analysis of Indonesia's economic journey.